We do believe it is that big. So if you look at the revenue growth the last 5 years, it's compounded at roughly 48% per year. And that was, as you recall, when Tesla was experiencing quite a bit of controversy.
Yes, we do think it's that large. Now, if you look at the revenue growth over the previous 5 years, it's compounded at around 48% annually. And that, well, you remember, that was when Tesla was dealing with a lot of criticism. Although Elon Musk, the CEO of Tesla, dislikes unions, he may be discreetly supporting Shawn Fain right now. The leader of the United Auto Workers is making bold demands for contracts with Detroit's big three automakers and shows no indications of giving in. Concerns over UAW strikes against the Detroit Three and rising interest rates. It's caused net outflows from exchange-traded funds that follow automakers last month. Just a few days ago, the UAW strike entered its 20th day, severely affecting production at General Motors, Ford, and Chrysler parent Stellantis. Given this, some people are certain that this would benefit Tesla at a time when conventional manufacturers are making a stronger push for electric vehicles. Wedbush analyst Dan Ives stated in a research note that if a strike occurs, manufacturing and the EV roadmap may eventually be delayed until 2024, and delays would be imminent at this critical time for GM, Ford, and he went on to say that Tesla stands to gain from any work stoppage at its competitors. This strike, in my opinion, will be the most serious and spectacular in 50 years. Let's discuss EVs in general. Not only Tesla, yes, is what's going on. In Detroit right now, good news for Tesla. Yes, since there will undoubtedly be additional production shortages in the event of a strike. Unfortunately, we'll have a lot of questions about it because, as you know, I believe that the supply chain has just cleared up. However, I don't believe it's actually related to the strike. It has everything to do with a change in consumer preferences toward better, more affordable cars, like electric ones. It's by simply passing cost reductions on to its customers. Tesla is driving that price fall. So I guess that's what's good for Tesla. Professor of business at the University of Michigan, Eric Gordon, told WNM Don Levy, an analyst at Barclays, said a strike was highly likely. A strike would harm the bottom lines of the Detroit automakers and slow them down. One against GM, Ford, and Stellantis, lasting 10 days would cost them over $1 billion. According to the Anderson Economic Group, analyst Sam Finney told the Associated Press that even though the Detroit automakers had almost 2 million cars on hand at the end of July, a 3-week or longer labor stoppage would swiftly deplete the excess supply, driving up car costs and driving more sales to companies. Cathie Wood discussed her opinions on Tesla in a recent Fast Money broadcast on CNBC, predicting that the company's stock will soar to at least $1,400 by 2027. Notably, Wood's bear argument for Tesla includes a price target of about $1,400. Over the next 4 years, she believes it is likely that the price of Tesla's shares will increase by a large amount. We hear complaints about people's inability to buy these cars. As you can see from the UK news, Rishi Sunak is delaying the 2030 deadline for the elimination of all internal combustion engines until 2035. Are we assuming too much about the energy transition and what this will be like? No, we don't believe that. About 2 or 3 years ago, the total cost of ownership of an electric vehicle actually dropped below that of a gas-powered vehicle. Okay, well, this is in the United States, so things are a little different here. Sticker prices soon as insurance included in that. Yes, it does include insurance. Yes, and as I mentioned, there are regional variations, but in the US, insurance is part of that. In fact, Tesla is willing to offer insurance because it is so confident that, well, its vehicles will have fewer collisions and fewer fatalities. That does in fact cover everything. Wood does see significant growth in Tesla's electric car sales, but EVs only account for about 1/3 of ARK Invest's estimated worth for Tesla. She told Melissa Lee of CNBC, the remaining 2/3 of ARK's valuation is connected to autonomous vehicles. Wood specifically thinks that Tesla has a huge chance in the field of automated ride-hailing or robo-taxis. In a report published in April, ARK Invest explained that by 2027, autonomous ride-hailing may bring in almost $200 billion in net revenue annually for Tesla. Note that this is the base situation once more. Additionally, ARK anticipates that Tesla will introduce a robotaxi service in the near future, with 2024 being the most likely date. In the aforementioned CNBC interview, Wood stated that Tesla holds the top spot in the US. According to Wood, Tesla has a significant edge as it possesses more data than all the other autonomous car manufacturers put together. Because of its advantage, the leader of ARK Invest does not expect Tesla to have a robotaxi monopoly. However, she believes that the market for autonomous ride-hailing would be a winner-take-most situation, and she believes that Tesla will emerge victorious. Wood thinks that safety in particular will be a major contributor to Tesla's success. She pointed out that texting while driving is a major problem and that auto fatalities are on the rise in the US. In car accidents, human error is by far the most common cause. People driving in Tesla cars are 40% plus safer with autopilot and FSD than in other cars, Wood says, indicating that switching to artificial intelligence-powered automobiles can help solve these issues. According to ARK Invest's April analysis, when adjusted for use on typical city streets exclusively, Tesla's FSD is 5 times safer than a manually operated Tesla. You might be wondering, what is Wood's bull argument for Tesla if her bear case implies a return of more than 5 times by 2027? According to ARK Invest, during the next 4 years, the price of Tesla's shares might increase by almost 9.5 times to almost $2,000. By 2027, Tesla's robotaxi revenue might reach over $600 billion, according to one bull model. Naturally, a lot of others contend that Wood's initial pricing goal for Tesla is likewise impractical. Her prognosis regarding the stock, however, will be accurate if her presumptions regarding the robotaxi market and Tesla's competitive advantages turn out to be accurate. Cathie Wood, the founder of ARK Invest, has a well-known history of being optimistic on Tesla. However, recent sell-offs of the automotive shares have raised some concerns among bystanders. Thankfully, Wood talked about why she sold her shares, saying that she still believes Tesla will succeed in the long run and that the investment firm has even become more confident in the business this year. In a Q&A session with Barron's a few weeks ago, Wood reaffirmed her belief in Tesla, despite selling off a sizable portion of the stock in recent months. Wood stated that she still has a price target of about $2,000 for the automaker's shares, and that the latest sell-offs were just the result of portfolio management. Wood said to Barron's, "Since Tesla is lowering prices, our confidence has increased. Because it is lowering the cost of consumer electronic batteries, it is among the few automakers that can afford to do that. The other manufacturers, whose costs are far higher, will suffer from this." Still, the sell-offs didn't go ignored. In fact, ARK Invest, run by Cathie Wood, made a big move a few days ago when it sold more than $25 million worth of Tesla shares. Given ARK's prior strong position on the electric vehicle manufacturer, this divestiture is a significant change and demonstrates a nuanced approach to portfolio management in the face of shifting market conditions. Through its flagship ARK Innovation ETF, ARK Autonomous Technology and Robotics ETF, and ARK Next Generation Internet ETF, ARK sold 97,599 Tesla shares in total. Based on the closing price of $261.20 at the time, the deal was worth $25.49 million. Over a 24-hour period, the value of Tesla's stock increased by 5.9%. The choice by ARK Invest to sell off a sizable amount of Elon Musk's stock highlights a strategic realignment. Given Cathie Wood's prior support of Tesla, the fund's decision is especially noteworthy. The transaction might indicate that ARK has to reevaluate its investment approach, perhaps in light of new opportunities and trends in the market. However, the Model Y has become the best-selling car in the world this year, and Tesla presently holds a 60% market share in the U.S. electric vehicle market. By 2027, ARK Invest's projects that 60 million EVs will be sold worldwide, with Tesla continuing to lead the industry in that year. Additionally, Wood views Tesla not just as a car company, but also as an artificial intelligence investment. This is mostly because of its autopilot and full self-driving FSD beta systems, the latter of which trains its AI for an autonomous future using data from human drivers. Elon Musk, the CEO of Tesla, said he anticipates that autonomous driving will help the company's future robotaxi venture, which may produce high profit margins similar to those of software firms. Nevertheless, Wood states that she believes Tesla is still in a strong position to dominate the US market for autonomous taxi platforms in the future, and that she anticipates the business will charge less for robo-taxi services than Uber or Lyft.